Hi, my name is Janelle, and this is Tim, Martin, Jacqueline, and Giselle. Welcome, Senior Management. We as your corporate finance team have analyzed Actavis's recent acquisition of Forest Laboratories and will present our analysis in this video. After evaluating the financial statements, it indicates that the current ratio is healthy and is able to cover its current liabilities with liquid assets. However, the asset management displays that Actavis is receiving money faster than it is paying suppliers. On average, it takes Actavis 119 days to pay its suppliers. Also, the cash conversion cycle is fairly high at 354 days. This indicates that it takes that long to convert products into cash through sales. Pharmaceutical companies usually have a high cash conversion cycle of 133 days. However, Actavis's cash conversion cycle is twice the amount. Additionally, the debt ratio is fairly common in the industry, but the debt-to-equity ratio is very high, indicating that Actavis has been aggressive in financing its growth with debt. The gross profit margin is considered high for a pharmaceutical company, but on the other hand, the operating profit margin and the net profit margin is negative. As we all know, Actavis's globalization strategy includes three principles. This involves internal product development, strategic alliances, and select mergers and acquisitions of products, technologies, and companies. The benefit of globalization is the utilization of synergies, as it provides ways to eliminate unnecessary costs in order to run more efficiently and effectively. This can be achieved by combining the talents and technology of two different companies to increase revenues and reduce overall costs. Since Actavis operates in over 100 countries, they're able to take advantage of free trade agreements to specialize in producing products in which they have a comparative advantage, thus allowing them to benefit from offering customers great value, wide product selection, and increased exports. In addition, globalization encourages economies of scale, allowing Actavis to benefit by increasing production as well as reducing costs for the company and customers. A potential risk for Actavis and Forest is the inability to utilize synergies to realize other benefits of the merger. Other risks include inability to achieve cost savings targets, not taking advantage of business opportunities, integration problems, combining two different corporate cultures, acquiring new customers while maintaining our regular clients, as well as incurring additional expenses. In order to combat these issues, Actavis and Forest have ensured that management is able to dedicate substantial time and consideration into integrating the business efficiently and effectively. Also, due to Actavis's previous experience acquiring companies, they've been able to learn from mistakes by establishing measures to prevent it from happening in the future. For example, foreign exchange risk and credit risk management.
The benefits of the acquisition. Well, first one is synergies. The transaction is expected to generate approximately $1 billion in operating and tax synergies within a span of 3 years. That doesn't even include an account for manufacturing and revenue synergies that are likely to occur. Actavis will also benefit from the already completed and announced acquisition of Actavis by Forest Industries. Specialty brand businesses. Prior to this acquisition, Actavis was known primarily for a generic drug model. This transaction, however, creates a world-class specialty brand business that is now able to compete across various market segments. With this purchase of Forest, Actavis will add the Alzheimer's drug Namenda and blood pressure pill Biostolic to its product lineup immediately, which will further bring up the revenues. North American sales and marketing business. The marketing reach of the combined companies is incredible. It has deep-rooted connections with primary care physicians, gastroenterologists, psychiatrists, cardiologists, nutrologists, and infectious disease specialists. Development focused on companies' generic and brand pipeline. With this acquisition, Actavis will now be one of the most influential development focused on R&D organizations in the industry. The transaction strengthens Actavis' specialty brand pipeline, with more than 25 drugs already in the making in the middle of the production stage, including new exclusive drug opportunities as well as robust portfolio of next-generation products. The management team. The new management team after acquisition is perfectly designed to help this company take it to the next level. It brings together exceptional talent with extensive experience to allow it to succeed in the bigger and more complex business. Risks. Forest Laboratories operated primarily in the US, Canada, and Europe, as opposed to Actavis that has its operations in over 100 countries. The total level of pharmaceutical revenue worldwide had reached nearly $1 trillion. North America is responsible for the largest portion, generating more than 40% of these revenues. This is mostly due to the leading role of the US pharmaceutical industry. It is predicted that North America, South America, Europe, and Japan will continue to account for a full 85% of the global pharmaceuticals well into 21st century. United States, while being the largest market, also is one of the most rapidly changing markets due to the evolution of the healthcare system in the recent years. The U.S. spends more on healthcare than any other countries in the world, totaling an estimated 17.2% of GDP in 2012. The implementation of the Affordable Care Act is most significant restructuring of the company's healthcare funding in decades, impacting all of its participants. In an inherent risk, political risk is not directly related to operating in the U.S., but it is because it's by becoming a major player in the North American pharmaceutical industry, Actavis' ability to continue foreign operations in the countries that have deteriorating political or diplomatic relationship with the U.S. forever going to be in question. Ireland, on the other hand, is one of the most original members of the EU and is impacted by EU's decision. Within itself, though, Ireland's growth strategy has been focused on export sector and attracting foreign direct investments. There have been a few calls to change Ireland's 12.5% corporate tax rate, even from the left-leaning parties. No Irish government is likely to undermine the clear success story of attracting foreign investments and multinational companies operating in Ireland. So this further eliminates any direct political risk towards activists coming from operations within Ireland as its home country.
So I'll be talking about industry-specific issues which are related to the acquisition. In the pharmaceutical industry, many acquisitions occur each year worth billions and billions of dollars. The industry has seen this trend arise as companies seek to create synergies by acquiring other pharma companies. According to a PricewaterhouseCoopers report on the pharmaceutical and life science industry, in the fourth quarter of 2014, there were approximately 17 mergers and acquisition deals announced worth over $100 billion in the global market. Of these deals, about 70% of them related to pharmaceutical companies. From the report, the main drivers of the merger and acquisitions activity in the industry are refocusing on core competencies through divestitures, globalization opportunities, consolidation and economies of scale, and adapting to market trends and opportunities. As mentioned by Giselle and Janelle earlier, in the case of Actavis acquiring Forest, they too are looking to create synergies for this merger. So moving on to the acquisition price. Actavis successfully acquired Forest Laboratories for approximately $28 billion worth of cash and equities. The per share price of this deal represents a 25% premium for the Forest shareholders. This deal was Actavis' largest acquisition to date and creates one of the largest pharmaceutical companies in the world. So Forest shareholders were given 3 options in order to sell their common shares. The first option is a hybrid of cash and stock. They are offered a 0.3306 share of Actavis along with $26.04 of cash. The second option is a all-stock option in which they're offered 0.4723 Actavis shares for their common shares. And the last option is an all-cash option which they'll be paid $86.81 for their shares. In terms of the fractional shares of Actavis, they are converted at a price of $219 per share. Prior to the speculation of this deal, Forest stock price was trading around the $30 to $40 range. So from a financial perspective of a Forest shareholder, this is quite favorable for them. In terms of how the acquisition price was determined, both parties used financial experts and advisors, Greenhill, Co., and JP Morgan respectively. So the last thing I'll be addressing is the financing for the acquisition. So the financing for the acquisition by Actavis will be a combination of cash on hand along with third-party debt financing. The debt financing consists of unsecured senior long-term loans, unsecured senior cash bridge loans, unsecured notes, as well as with the Actavis's revolving credit and guarantee agreement with the Bank of America. Acquiring these loans will also come with conditions and covenants that Actavis must maintain to ensure that the bank does not call their loans. I could not find any specific details on the covenants, but only that they had to reorganize their current agreements with the banks. According to Bloomberg Business News, Bank of America, Merrill Lynch, and Mizuho Bank will be providing the bank loans for the acquisition deals. Other considerations for Actavis is their debt ratio. If they rely too heavily on debt to finance the acquisition, it could negatively affect their debt ratio and cause their cost of capital to rise significantly. It is important for them to assess their debt ratio and ensure that they stay within the optimal 30 to 60% range for their debt.
First, we're going to be looking at the multinational tax considerations that Actavis needs to take into consideration upon the acquiring of Forest. At this stage, Forest is a United States corporation, and they report all of their taxes and corporate tax to the U.S. They are recording at a 35% tax rate. They have their foreign sales in Canada and Europe, which has a foreign tax credit agreement with the United States. This means that the taxes paid for the income from those foreign countries are taxed at the foreign country, and then the repatriation tax is charged from the United States for any difference between the foreign tax and the United States tax. At this stage, Ireland also has those foreign tax credits agreements with the United States, Canada, and Europe, meaning that in transferring the Forest laboratories to Ireland, which has a corporate tax rate of 12.5%, they will actually be reducing any taxes spent. It is estimated that Actavis will save approximately $1 million in taxes due to synergies in not just the repatriation taxes being reduced, but also for the factor that their expenses can be matched to the revenues being made by Forest laboratories and the other companies they already own in those countries. We'll also be looking at their exposures to the transactional, translation, and operating. At this stage, their translation exposure will be relatively high for a little while until the corporation is over in Ireland. They are in process of ensuring that all of their expenses and revenues are matched in the foreign countries to reduce the amount of translation exposure that happens to the factor that there won't be as much coming over into Ireland. They're also working very hard on that for the transaction exposure, as they're trying to make sure their contracts are matched with the other contracts in those foreign countries. As for the operating exposure, it's the same concept. They're combining all of their companies in the foreign countries to ensure that they're reduced. They have not at this stage done any of their hedgings. They do not run a hedge system. That is possibly to be changed in the future depending on how their acquisitions continue at this time.
There are other factors that both companies need to consider before they're agreeing on the merger. Now, one of the things is the intended tax treatment by IRS. As we mentioned before, there are three options available for Forest shareholders: all stock, all cash, or stock plus cash. Now, the tricky part comes within the taxable gains from the stock exchange. A little bit of background of this merger is that Actavis acquired Irish company in 2013, and as a result, they established themselves as a foreign corporation in the U.S. And the U.S. Tax law requires the shareholders to report gains if they do stock exchanges between a foreign corporation and a U.S. corporation under certain circumstances. As we mentioned before, Actavis is an Irish company, and therefore the shareholder from Forest need to consult their tax advisor to make sure their tax impact of this merger is minimum. And secondly, both companies need to realize the governing law will be different. As we know, Actavis, it's an Irish company. They'll be governed under Irish law instead of Delaware law in the U.S. And one example of the difference is that under Delaware law, the company can issue authorized and unissued common shares to the public. However, under Irish law, the company can issue common and preferred shares without shareholders' approval. And the difference of the law will give the shareholders of combined entity different rights, and therefore both company shareholders need to consider the impact of the governing law. Also, this merger has to go through regulatory approval by different government agencies. One of the approval is the waiting period under the HSR Act, which different government agencies such as the FTC, they will have to assess the impact of this merger and approve the merger. And also, this this merger required to go through antitrust and competition laws in the US before it can happen. And moreover, both parties are facing huge termination fees from this merger. If the shareholder of Actavis refuse this merger, the Actavis need to pay $300 million to Forest. And if Actavis change proposal because certain situation happened, they have to pay up to $1.1 or $1.2 billion to Forest. On the other hand, if the shareholder of Forest refuse the merger, the Forest need to pay $250 million to Actavis. And if Forest change proposal under certain situations, they need to pay close to $900 million to Actavis. And both companies need to consider the potential termination fees they're facing in this situation. Thank you for watching this video. I hope you enjoyed it. Thank you very much.